Thank you guys all for joining our October NAV update. These are, anticipated meetings that, a lot of our investors love to see. We're able to get our leaders on here to talk about the exciting updates of the fund in general. And then this meeting is going to be a little focused in our top offering, which is our growth fund there. The Select Fund, which is our fully diversified HEI fund. So with that said, I'll give a quick intro of just who we have on call today, and then we'll get right into the good stuff. So here, joining us today, we have co-founder and COO of Nada Holdings here, John Green, and myself, manager of investor relations. John has a bunch of experience just in mortgage, 10 plus years in mortgage and fintech. Ground up, he's the vision here. He started this company back a while ago. I think John, maybe 4 or 5 years ago. And then myself, background in investment banking. I was at Citigroup, did some fintech stuff before that. And it's an honor and pleasure to work with all you guys who are on call. I see some familiar names already. You guys join and you guys give us good feedback and let us know what we're doing well and how we can improve and all that good stuff. So it's just been a pleasure to be in this seat and work with all you investors there. Next slide. I think we'll get into an agenda here real quick. So we're going to go over the NAV overview, which I'll pass to John in a second here, and he'll kind of steer the ship with what's going on with the fund from his view. And then we'll go over the HEA asset overview. We'll talk a little bit more about, okay, we have these diversified funds. Now, what's actually bundled in these funds? What is the asset that we're going after there? And then we'll go into the Select Fund, the update about what that new price is going to be. And then John's going to take us through some exciting general company fund overview updates that we have and some big partnerships that he's been leading on that side to kind of get set up for us. And then we'll talk about some promos and incentive at the end there to get inside the fund. And then, of course, what a lot of you guys like is we'll get to the question and answer at the end there. And that's how we'll go. Just those 6 things, and we'll let you guys get off. And again, appreciate you joining. John, does that look good? Anything else you'd like to add before we pass it to you for this overview?
No, that's perfect, Deyon.
Great. Take it away.
You got it. All right. Thanks, Deyon. Thanks again, everyone, for attending and being interested and attentive to what we're doing and building here. I always like to start with some kind of a basic fundamental recap, make sure everyone's kind of on the same page with really what we're offering and how it's constructed. So as Deyon said, the fund we're talking about today is our Select Fund. And this is primarily an equity growth fund by nature. And really, so when you look at that, you think about the thing that you're getting, the thing of value you're obtaining, it is really the net asset value at a per share price. And so when you think fundamentally, what is net asset value? Well, we're taking your invested capital and then pulling it, and we're seeking to make investments with that money that's worth something more than the dollar that we got from you guys. And so when you take net asset value, in our case, it's a little bit more straightforward because these are not esoteric assets. These are specifically residential real estate assets. But you take the market value of the asset and you minus any liabilities such as debt that we have or any other expenses, and then you get to what the net asset value is. And so if you guys were to give us $100 and we went and bought something for $150, well, that's good. It's $150, but maybe our operating expense was 20. So now that's $130, and we would divide that by the number of shares. And that's quite simply how you really track what is the value of what you've invested in, because it's a diverse pool of many assets, in this case for this fund across the US. But this is that one single thing you're really tracking. It's similar to a share price. It's just the way in which we do it is very straightforward because, again, it's real estate assets. So we're actually updating the value of the homes on a monthly basis using property valuation tools to do so, as opposed to some kind of arbitrary type valuation, with a a company traded in the stock market or some other different alternative assets that don't have such a simple way to value the asset. Yeah, so we can go to the next slide real quick. And again, kind of a fundamental reset. The critical thing that you are investing in is, this is a vehicle, an investment vehicle, Select is, and the asset that you're getting exposure to is an amazing asset that I love for so many reasons, but it's called a home equity agreement. And so what is that? That's a home equity agreement is an alternative to debt for homeowners, where a homeowner has equity built up in their house and they're seeking a solution to get cash out of it without having to take on new debt or having to move. So a home equity agreement is technically it's an option. It's a future option for their home. So what it does is it gives a homeowner cash liquidity, again, without any monthly payments or anything. It's repaid upon sale or refinance. And so it creates a tremendous value. And because we at NADA, we both are the issuer and manager of these funds that we're talking about today, but we're also an originator to homeowners. So we do this, we acquire these customers in-house and we originate directly to homeowners. There's a lot of tremendous stories of how the customers are using these products to help. Majority of how we are sourcing these assets are through affiliate business partners, such as solar finance companies, where a solar company is going to a homeowner and offering them, solar to help on their cash flow, to help with, increased future value of their home. And this home equity agreement is the means in which that homeowner is financing it. Now, we love that as a fund manager because the homeowner is getting cash out of their home to then reinvest into something that's going to, increase the value, sustainability, and even the environment in this case. So this is really critical. Now, the great benefit of giving a homeowner cash without the burden of debt monthly payments comes with a great asset for an investor, because the way it's structured is that when we go invest into a home, let's say we're buying 10% we're cashing out 10% of a home's value. The way that the contract is structured is we're then securing 18.5% of that home's future value. That's in effect the way that the pricing works. So that's a tremendous upside potential for you guys as our investors in getting exposure to this asset. But in addition, and maybe one of the most important things to think about this, is it gives you extreme downside protection. Because what that means with that 1.85 multiple, where you're going, again, in this example, 10% becomes an 18.5% of the future equity. That means that home value is would have to have declined by greater than 45%, over the term of the investment, for that investment in particular to be, at the risk of being out of the money. So you have tremendous downside protection and very strong potential on a very stable asset class, again, residential real estate. And by the way in which you're doing it, there is actually a benefit to the homeowner and how you're providing liquidity and optionality and flexibility for a lot of homeowners. So it's a bit of a preview, or a kind of a recap rather, of how that works. We like to do these often. We can dive deeper into a different session. All right, let's see what we got next. Let's go into the updates.
Yep. This is the big stuff everyone's asking for. Is, hey, John just took us through, what's going on with the fund, how it's structured, the asset we're at. Now, from an investor standpoint, you guys reach out to me and say, hey, how are we doing? What's the actual performance? Like, I just gave you guys some money. Now, what's actually going on? This is the part where I'd really tune into, because this is where we can see, okay, John's going to take us through, where we're at today, what we did over the last 3 months relative to how that compared to the real estate market the last 12 months as well. And then you guys can tie back to, okay, now what did John say before that and how those two correlate? John, anything on this particular slide before I go into the last 3-month performance that you want to call out here on screen, or should we just get into it?
Well, yeah, I mean, I think that this does illustrate the many moving parts, but in particular, the asset exposure and diversification that is most unique to the Select Fund, which is something, it's just, we're real excited about this fund, where it's going and how it's performing. And that's maybe the one thing to start here, and then let's just go right into it. All right, so we're going to start with just looking over the last 3 months. For those of you that have attended these sessions recently, that we're doing a rolling 3-month update on net asset values for our funds currently. So when we look back, this is what we're looking at. The Select Fund fundamentally offers the most diversified exposure to these home equity agreements that we offer across the platform. Our flagship funds are the city funds, where you get very targeted exposure to certain cities with these assets. Select Fund gives you exposure to those cities, to those city funds, because it invests into them as a fund of funds. But in addition, Select also makes opportunistic investments in HEAs that could be really anywhere across the US, as long as it meets the criteria and really has an opportunistic profile for us to invest in. So the fund by its structure has a lot more flexibility for us as a fund manager, to where you can very actively manage your capital and put it into investments that we see the greatest potential for return. So again, over the last 3 months, the direct investments made from the Select Fund are 5. We spent just under $525,000 to acquire these assets, and the current market value of these assets is right at $600,000. So this again is that whole how the contracts are structured, and that in the money upon acquisition, structure. It creates a big lift for our investors coming into the fund at the point in time where we're really deploying capital. It's just we're very actively doing with Select. Now, the interest Select holds in the underlying city funds gives you exposure to those assets as well. And so the interest that Select held, it ended up giving you indirect exposure, but again, the same type of economics when it comes to your value, which is the net asset value, to 24 additional HEAs, which we spent right at 2.1 in acquisition costs, and we currently have a mark-to-market value of those is 2.8. I want to anchor again, the market value of these assets is not something arbitrary. This is something that's scrutinized for us internally, publicly filed with the SEC, and very purely tied to the value of the real estate, the residential real estate that these contracts are on.
Yep.
All right, let's see. All right, so just to put some perspective here, because Select is diversified across the U.S., we said, okay, over the last 3 months, what is the U.S. home price appreciation rate? In the last 3 months, U.S. home prices, they really haven't appreciated much. It was 0.28, as you guys see here in the top. Now, over that same period, this fund has given, if you are a current investor, really, just let me say, any investor in Select has had appreciation of 3.1%. So we always want to be, tracking against that, and ideally we want to be outperforming it because of the uniqueness of our asset and our ability to acquire great deals. And then at the bottom there, you just really see, okay, well, up until this new share price, the current price that someone could buy at is still $112.85. But where is it going? It's going to go to $116.35. That's how you can see that actual dollar change. And that again is that net asset value just broken out on a share basis. All right, same concept here, but now let's expand it out and look at this over the last 12 months. Again, you see pretty modest home price appreciation across the U.S., just under 3%, but the Select Funds net asset value is up 16.35%. So that's right in line with where we're targeting this fund to be. We've got a lot of we got a lot of positive things coming into which we'll talk about with the Kyle facility and our ability to obtain more assets. It's going to even further that. But again, you can see when we went to market with this fund, the initial offering price, which no future share price can be guaranteed. There's so many different obstacles that can happen, but his history with us and our funds, and really any pure fund, you want to get in at that initial offering price. That gives you the greatest potential for upside. And you can see if you were to have bought when we initially took Select to market, it was at a simple $100 per share. And that share value is now going to $116.35. Okay, so we're going to look at what is the total home equity exposure if you are an investor or you're considering Select. We like to add a little bit here in terms of what's the homeowner using our home equity investments for. I talked about this a bit earlier. By and large, it is solar and home improvement. We do have some really good some big name partnerships that we're working on the debt relief, debt consolidation side as well. that really creates a positive impact. And maybe I can just double click on that a little bit to give you guys some tangible understanding as to how this asset is working for a homeowner. So let's say a homeowner has recently had some hardship and they're in, current distressed state with their debt, but it's one of these events. It seems like it's an anomaly, it's an outlier event. So they would otherwise qualify for a product, and we can then say, okay, well, we're going to give you cash out of your home, but when we go to close and fund this using a title and escrow company, we're going to make sure that these debts that you have that need to be paid down are paid down, and we'll instruct when we fund that the escrow managed at the title company is actually issuing to pay that down. So we know it's being paid down, and then we can actually rescore the homeowner's credit to see what the actual positive impact is. So even when we're doing that, similar to helping someone take cash out to invest in their home for improvements like a kitchen remodel or to install solar, we see that tangible benefit to the quality of the collateral. And that's always a core objective and goal and kind of a mission for us here. So get to the numbers. All right. So when we launched Select, it immediately invested in the underlying city funds. So that's how you see that 68 HEAs at launch. So when Select started getting capital, it invested in the underlying city funds and got exposure to 68 assets. Now, since Select has been active, we've added an additional 97 HEAs over this period, and we have 165 that we've got in total. And another thing is we've realized 16 payoffs, and these payoffs on a simple return basis have generated 16.2% return on the dollar we invested in the home versus what they paid us back whenever they sold their home or refinanced. And so that gives you a sense of how that asset's performing. That's not on an IRR basis. That number, because some of these are short-term payoffs, would be a really high number, but it's better to look at it in a more longer-term view so that's more realistic numbers. So that's actual payoffs, actual realized returns on those assets. And here's some of the stuff that we're getting excited about. So now we've been originating these assets and growing these funds and really trying to get our position in this market that's an emerging market, that being the home equity agreement market. And we've got some great partners to source homeowners, as well as additional capital to help us accelerate our origination. So what's in the pipeline? We have almost 40 deals in the pipeline over the next quarter, which is to say the next 3 months, since we're kind of in an out-of-quarter timeline here. And the anticipated acquisition cost of these is 3.7, and you can see the projected value of these assets is right at 4.6. So we have a very strong pipeline currently that's about to go into this. And this is really, if you're thinking about investing and you can see that there's a big pipeline coming up, we want to get better about sharing this with everyone so that you guys can see what's coming and know when it's a good time to get in and buy, because you can kind of see how that's going to affect the future value of your shares.
Yep.
Okay, so I think we internally were all over the place on how to do a visual here. So pardon if this is a hard read, but we wanted to just illustrate that one of the unique factors of Select is unlike our Austin City Fund and Dallas City Fund, which we love, it's very targeted. This is very diversified. So you can see here, this is a bit of a snapshot of the MSAs based on the current allocation. But a good number is if you're investing in Select right now, you're getting diversification across 20 plus MSAs right now. And you'll see the largest ones are the initial funds we launched with, right? So we launched with Dallas, Tampa, Miami, and that's where we got going. And then we've now scaled, started to add new cities, and you'll start to see those other quadrants grow and grow and grow now that we have more capitals and more cities that we're originating these assets in. Okay, so we recently announced that we have completed a partnership and closed on a credit facility with an institutional grade asset manager called Kawa Capital. So Kawa is, again, an institutional grade asset manager, tremendous team based in Florida that has around $4 billion in assets under management. They manage these assets as they have a bit of a hedge fund, They have some opportunistic credit funds and some equity funds. And so they have, various ways in which they're participating in different assets, but a very professional structure in how they do it, because their point of entry and looking at, partnering with someone like us for, how to give us capital for new assets, thinking about the scalability and opportunistic. Um, their target would be like an asset that is in that, going from an esoteric asset, as you would call it, to more of an institutional grade, and really that opportunity window that's right there. They're a really good springboard for that. And that's what that critically means for us. But most specifically, what does that mean for investors and, you guys listening today, is that this 25 million facility means that we're now able to add credit leverage to our funds to where we can acquire more assets based on the dollars you've invested than otherwise if we were just using your capital. And the structure and cost of the facility is very advantageous to the return on equity profile of the home equity agreement. So kind of simple numbers here. Let's say this means that if we had $1 million invested from you guys in a month, we now can say, well, we can access another around $700,000 in credit to match it, and we can increase those acquisitions at a higher velocity. And it's really one of those effects that as we continue to scale it and grow, it will continue to grow. So we'll be able to draw down more and increase the size of the facility and ultimately acquire more assets at a faster rate, which is going to generate higher returns for investors that get in now rather than later, because again, we're going to need to deploy this credit alongside your equity. And so that's really what this represents is leverage, benefits you, because now we're managing the debt and we're, working with that, and we can increase our velocity to acquire assets. Another thing to add to this is that you now definitively have the opportunity to invest in a facility that is alongside an institution. And so you have this opportunity to where when we launched, any of you early investing in this, the home equity agreement as an asset, was still really emerging. And over the last, I don't know, 6 months, probably, that market has formed more. Now we're seeing securities rating agencies, DBRS and KBRA, have published ratings on how this asset would be rated. So now it's more akin to a mortgage-backed security, and the capital markets are moving towards that end. And so with a group like Kawa coming in, they did an extreme level of diligence on us and how we originate, how we manage, how we track performance, all the critical elements of how we're interacting with this asset, and they gave us a substantial, stamp of approval, if you will, alongside granting us the additional credit. So it's a really great signal to where the macro market is, and then specifically targeted the benefit that we can provide to you guys as our investors. As it stands today, the only way that anyone can get in and get exposure to this new facility is through the current active offering of Select. So this would be the only opportunity that you would have to get in early alongside Kawa. Okay, so always whenever we have a company milestone, a key event, we like to put our cash aside to help offer you guys an extra bonus if you're looking to participate, so that not only can you get in at an opportunistic time, but we'll actually put some cash in with you to help you get a little bit extra to boost those returns. So very excited to share with everyone that from now until the end of the month, October 31st, you can currently buy shares of Select at the current price, not the new one. The new one's where we're going. So you can get in at that price, and you can get an extra bonus from us if you invest in certain tiers. So the best offer we have is that we'll give you a 7% bonus if you invest 100K or more in Select between now and the 31st. And the best way to do that is to schedule time to talk with Deyon, who will share his contacts with everyone shortly after this. So you can really understand what are your goals, and he'll walk you through all of that to make sure you're getting the best of it. And then we have the different tiers. So if you're looking to invest a lesser amount, we still have options where you can earn a bonus as well, to where you can really kind of jumpstart your returns and how you invest in the Select fund, and hopefully be along for the ride for a while, and what all the exciting updates we have to share soon.
Yeah, thank you so much, John. Great opportunity. Please reach out to me. I'll place my email and my direct business line in the chat for everyone to see here as we get ready to get to the end of our presentation. We get to the Q&A. So this is a great opportunity for all of you on call who may have had questions the past week or the past month or anything you've seen. John and I here, we'd be happy to answer these. So go ahead and open your Q&A chat box at the top there of your screen, and just go ahead and type a question there, and John and I will get the questions going. And I think I see one here already from Jeremy. So, and John, maybe you can answer this one a little better than I can. So, what is the cost of Kawa debt? And that's
Yeah,
just, go ahead.
yeah. So Kawa is a revolving credit facility. So a little bit different. We are updating all of our SEC filings to articulate really the construct of how we formed an SPV and the relationship. So my point in saying all this is that you'll have visibility to the details of this in a updated filing here soon. But the cost of the Kawa debt is a floating rate that is in the 11s to as high as 13% interest and the pure interest. And there is a custodian. There is some banking fees that are relatively minor, but when you say miscellaneous, that would be part of the third party fees that are associated with it. Because we wanted to alleviate some of the burden of there's a lot of legal costs. There's a lot of stuff that goes into creating a credit facility that is willing to accept a borrower, not only in Select, bear in mind, it's also the borrowers to the facility are all of our series LLCs, our cities that are comprised of you guys as investors, and then the asset is still a new and esoteric asset. So it was really a first of its kind type credit facility. And so in order to alleviate some of the costs going into it, we as a manager have absorbed some of those fees to reduce the burden in terms of the initial closing. But then how the distribution of any of that upfront versus ongoing is something that you'll see in very transparent disclosures.
Thank you, thank you. I see another question here, and I can certainly take this one. The question and see anonymous there. So I'm not able to reach out to you, but the question is, when and how can I start investing? And the wins is immediately. You can go on cityfunds.com right now, click on select fund, put in your information. I'll either see on the back end, or you'll be able to get pushed right through and make your first investment there. Fully self-serve on the website. If you want a little bit more one-on-one attention, want to talk more about our markets or just the future vision of city funds, or any other questions you have, you could reach out to me here, Deyon at cityfunds.com, or I'll place my number here as well, and you can just give me a quick ring, and we can set up some time. We can talk all day about investments, finance, real estate, and I could personally get you onboarded. I can transact your investment for you. I can take care of your accreditation, as this is an accredited only offering. I can do it all there if you want to get more of a white glove experience, because I love connecting with investors and taking care of and getting to know you guys all more. So definitely reach out there, send me an email, or give me a call here at this number.
Yep.
Thank you.
I will echo that and extend it to the greater team here. We understand and appreciate your thoughts and considerations when investing, and we're not expecting you to do so so blindly. We're very very open and here to discuss any and all of it. I think there's one more thing I want to make sure I share with those of you that are still with us, and that is we have an exciting new investment product that we're launching in the next couple of weeks that we'll be announcing. We'll be inviting it to a select few people to first come in, but we're going to do an initial private offering of a new city for the first time, and we're going to offer it to a select few of our known accredited investors to get in. And this kind of goes back to one of those things where I shared earlier. The best opportunity is to get in at the initial offering price. And so that's what this is going to offer for you guys. So definitely stay tuned. It's an exciting new city. We're finally doing something a little bit more on the East Coast, which I'm excited about. And I think you guys would be excited about the opportunity as well. So be on the lookout for some upcoming invitations and opportunities to learn about this first new fund.